I hope we're live. This is Value After Hours. I am Tobias Carlisle, joined as always by Jake Taylor. Our special guest today is Kai Wu of Sparkline Capital. How are you, Kai? Welcome to the show.
I'm good. I'm glad to be on. I like the name Value After Hours.
Well, the idea is that it's a more relaxed conversation, the kind that you'd have after going to a conference in the bar afterwards, talking about the
Talking
things
real
that.
shop.
So,
Yeah, I thought it was after market hours.
yeah, well, there's
So I
that
was like,
too.
wait a second, market's not closed yet.
No, I know it's confusing. It's in the middle of the day, but it's after hours.
Yeah, it's 4 o'clock somewhere.
Tell us a little bit about Sparkline Capital and your approach to investment.
Yeah, so look, I'm glad to be with you guys on this value podcast. You, you may find me to be a bit of a black sheep, but I do actually hail from the school of value. I started my career at GMO actually, and have been a value investor since basically entering the industry over 10 years ago. Worked for Jeremy Grantham at GMO, and then was part of a spin out of a hedge fund spin out there, kind of the number two guy on a quant hedge fund with another GMO partner, and then started Sparkline in 2018. And kind of the idea here is to continue to evolve the idea of value investing, but to take into account the changes to the economy that have happened over the past century or so, namely the rise of intangible assets, things like intellectual property, brand equity, and human capital that, at least based on the data I look at, are comprising a kind of increasing share of the value of companies, especially US and especially large cap companies.
How do you define intangible capital and how do you then track it and make it sort of comparable on an apples to apples basis between companies?
Yeah, so the kind of framework I use is I have these four pillars of intangible assets because intangibles are kind of by nature heterogeneous, right? It's hard to compare apples to apples in general. So I think having a framework where you create separate pillars is helpful as a starting point. So the four pillars are intellectual property. So that's like patents, but also kind of trade secrets and any kind of software code, know-how that's held at the corporate level. The second is brand equity. So think like Coca-Cola, LVMH. Third is human capital. And then the final piece is network effects, right? And that's think of like, Google search or Facebook or even AT&T or the New York Stock Exchange. Anything where adding more nodes to the network increases the value for all users. And that's becoming an increasing large component of value for the big tech platforms, of course.
And
So then
how
what
do
kind
you,
of
yeah,
adjustments to the accounting? Like where is GAAP wrong now in the new world?
Yeah. So you're bringing up an interesting starting point. So when I first started doing my work on intangible research, I did start with the accounting statements, right? So go to the 10Ks and 10Qs. And one of the inconsistencies that you, of course, are aware of is that physical capital expenditures are capitalized, whereas R&D and marketing, intangible investment is expensed, right? And so that's effectively punitive towards companies that conduct homegrown R&D, homegrown marketing. Now, there's a weird thing where if you do an acquisition, you get this goodwill item, and you can capitalize that with like impairment things. But for the most part, companies that are intangible intensive are penalized relative to those that are more asset heavy, more traditional businesses. So the first thing I did was, following the work of several academics as well. So this is well known. Did work on trying to kind of make intangible capital expenditures kind of on a consistent playing field. And so you can actually capitalize R&D, say, each year and kind of amortize it over some period to build up a balance sheet item, which is, intuitive because, now Coca-Cola or, any kind of like tech company whose book value is like 1% of their total value, that kind of becomes somewhat corrected, where like now you're giving credit to, say, Coca-Cola for having an asset on its balance sheet that it's the brand that is being created over $100 billion of advertising, or for a tech company, all the R&D spent building out whatever software they have, and I found that to be helpful. Right. So if you think of your baseline as being, say, Russell 1000 value versus market, and you say, what if I, redefine, the book value component of Russell 1000 value by adding the capitalized intangibles? Well, the performance has been less bad relative to the market over the past, say, decade, but it's still not amazing. And so that led me to the next point where I said, maybe we need to kind of consider metrics beyond accounting information. I think accounting information has two, limitations. First is that just the amount of disclosures mandated by the SEC are limited, right? So you have like headcount on the human capital front, but I mean, that's not obviously distinguishing between the CEO and, their assistant. So there's that component. And then there's the other piece, just that like the the kind of output function, input output function of say R&D or even marketing is pretty like, nonlinear, where two companies can put $100 million into developing a drug and one ends up with Ozempic and the other with nothing, or two companies can buy Super Bowl ads and one goes viral, the other one doesn't. So you really need to focus less on historical cost, which is, by definition, what accounting does, and instead on the output of the kind of production function that is R&D and marketing. And that is what led me
So what
to
does that show up then on like, does that just show up as revenue at that point?
No, so ultimately, yes. Ultimately, the end goal is to, model something that will eventually trickle into revenue. One thing I found is, and this is a separate result, is that intangible investment, and I'll tell you how I define that in a second, tends to lead to profits and earnings per share growth with a pretty long lag. If you look at if you sort companies by their intangible value and then look at how that filters into EPS over the next decade, the first year actually decreases EPS, right? Because you're obviously spending money to make money, and then it J curves up such that in 10 years, it's a very valuable thing. You've now created a moat. You have a patent. You have a trademark of some brand that you can now charge premium prices for the product. But it takes some time for that to filter through to earnings. Now, how do I define it? That's kind of where I guess I'm a little bit different than most folks in kind of the traditional value school, which is, my background is as a quant investor, working for GMO. And, I got pretty into like machine learning and alternative data, I guess relatively early on, and ultimately what would become AI, so natural language processing. And so a big component is to try to identify unstructured data sources, alternative data sources, to quantify each of the different pillars. An example might be to look at like patents, right? Is an intuitive place to look for IP or trademarks for brand, social media for brand. Other examples might be like LinkedIn posts, sort of LinkedIn bios. So you can kind of build up a snapshot of the human capital stock of a given company at each point in time. And so intuitively, these sources have a lot of potential value for quantifying intangibles. And of course, like the challenge then becomes, just the size of the scale and the fact that much of this data tends to be unstructured, and trying to figure out how to work with that to kind of build structured factors that can then be kind of put into a more traditional quant process, which would be kind of effectively an ensemble approach, similar to like combining a composite of price to book, price to sales, price to earnings, et cetera.
Any surprising correlations that came out of the machine learning process, like things that you are counterintuitive?
No, I mean, actually, I think the results are pretty intuitive, right? Like if you look at, say, a list of the companies or the sectors, say, with the most, intellectual property intensive sectors, it's technology, communications, healthcare. On the brand side, it's consumer discretionary, consumer staples. On human capital, it's finance, tech, healthcare. And the network effects would be kind of communications would be the highest, followed by some tech stocks too. So I think it tends to be somewhat intuitive, actually, the way kind of it all shakes out. I think what's interesting is that, we've managed to find a way to quantify things in a systematic way, right? Because, most managers will say, yeah, of course, intangible assets matter. Don't tell me they don't. Everyone knows that. It's just a question of how you go about, building up a systematic scoring process to identify these things, in a quantitative way.
Why wouldn't the value of intangible assets just turn up in greater earnings or cash flow, or why can't you measure it just as a flow rather than having to sort of do these additional exercises to show where that
You're trying
intangible?
to get out in front of it, aren't you, a little bit, like, and see when is you gonna get those big paydays?
Yeah, I think it goes to the J curve idea, right? Which is that like a lot of intangible invest. You think about Amazon being the perfect example, right? A company that never made a dime for their investors for decades, and now is worth multiple trillions of dollars. How do they do it? Well, they basically reinvested into the business, building out customer goodwill through charging prices that were very competitive for their building out the logistics networks, the network effects, and then ultimately AWS, which has been a big profit center. And so, yeah, if you look at the trailing earnings, trailing free cash flows, it looks okay, but still very expensive. If you look at it on an intangible investment basis, actually they're making really interesting investments into these intangible assets. And for a long time, it would have been a very attractive stock, on that basis.
So you say that it reconstitutes these value indexes so that you find what you would inexpensive relative to some measure. It makes them you're pumping up the measures of some of these so you can see how truly undervalued they are.
Yeah, I mean, relative to like a more traditional price to book or even like a price to earnings, kind of any traditional value metric, you're going to end up with a portfolio composition that is, a little bit different. So less banks, less insurance, less asset heavy businesses, materials, energy, et cetera, and more technology, consumer brands, communications, healthcare. And it will vary by region. Like one thing we find is applying the same methodology to the US and to the non-US geographies, you end up with a lot more tech in the US because that's where all the talent and innovation is, and a lot more brand outside the US, which is, if you're thinking about Europe, that kind of makes sense. And then through time as well, through time, things have changed. Obviously, network effects are a lot more important today than they were 20 years ago because, now you have 7 billion people connected on Facebook. Back in the day, we didn't have that. So these things can kind of change through time. I mean, also, if you go back 100 years, none of this is important or very insignificant. And so it is kind of a dynamic process by which, intangible assets have kind of become increasingly important for the day-to-day investor.
I was looking
Are
through one of
you,
your documents and I saw you track the number of PhDs.
is that a leading
Yeah.
or is that you want to
Well, actually,
short a lot of
let
PhDs?
me tell you a fun let me tell you a fun story. So actually, PhDs, at least historically, right, have been a valuable indicator, not just for, and it's not just a tech, it's not just a tech proxy, right? It's like adjusting for sector. Let's say the companies that are investing more in your high end talent, folks who are coming from MIT, PhDs in machine learning. Those guys are pretty good and pretty sought after. So to be able to pull those people is an attractive thing. One fun thing I did was I also look at MBAs. So MBAs are actually a negative signal.
Ah, damn it. I knew I was wasting my time.
Yeah, you're setting yourself up for that one.
Yeah, stepped right into it.
So there is a positive correlation. The more PhDs you have, the better your returns.
Stock returns adjusted for price. So everything's normalized by market cap. So in this case, like, it's not just number of PhDs because then you're just getting large cap stocks. You're saying, hey, per dollar invested, how much intangible capital am I getting out, whether it's PhDs or trademarks or patents. The whole idea is like a dividend yield. Because we're value investors. If you build a portfolio simply of like the most intangible intensive companies, highest R&D divided by sales, highest PhDs divided by total employees, you basically get tech, which is fine. But like, I don't know to what extent that's persistent moving forward because while tech has outperformed historically, right now it's kind of priced in. Everyone knows that these are good companies. And while network effects were, for example, underappreciated for a long time, people kind of know that these things are not important now. And so now the key is finding undervalued network effects where it's not already priced into the stock.
It would seem like also if you're having to fish for these people with $100 million signing bonuses, at some point that's kind of neutralized a little bit, isn't it?
Exactly right. If $100 million is coming out of the stock, in stock-based comp or whatever somehow, then that's going to offset whatever value these people bring to the table for sure.
Can you take us through some of the positions and how they would be turning up in your portfolio and sort of defying a more traditional classification of those positions?
Yeah, what's sort of
So
the biggest surprise jump from what would say like traditional value would say it was, wildly overpriced or not good or something versus like the insight that you have from your process?
yeah, I mean, so Toby and I were talking a little bit about this before the call. I think Mag 7, right? That's basically the entire game these days, right? All people think about is Mag 7. And it has, to be fair, driven the returns of the market for the past few years. And so actually, in 21, when we launched, our product, some of the largest holdings, and this is something that's public, so you can look it up. It's not, we're actually Mag 7 stocks. And, the Wall Street Journal actually wrote an article on us saying, the value investor buying big tech stocks, as if it were kind of like a weird thing, which it kind of is, right? Like, but, maybe today Meta is in the index, but like, it wasn't always like that. And the question is why, right? These stocks, many of them traded at price earnings ratios that were very high. Like Nvidia was at 100, Amazon was really high. Why would we buy these things? And I think the reason is that if you add into the mix these intangible assets, right? Nvidia has CUDA network effects. They have very well known a culture that's well known to be innovative. They do hire a lot of PhDs and employ a lot of very talented folks. You kind of tally all these things up, and actually on a relative basis, these stocks were at the time at least amongst the cheapest things on the market. Now, obviously, fast forward 4 years and times have changed, and everyone knows Nvidia is a great stock, and the stock price is up like a million times. So, maybe it's no longer cheap, but you kind of get the idea that, when you adjust for these things, it does change the relative, it kind of reshuffles the deck a little bit, generally in favor of intangible intensive industries like technology. But more importantly, even within those industries, certain names tend to benefit more from these adjustments than others, of course, as you would expect.
If you're not expensing something, so in the traditionally a tech company would be they expense whatever or it runs through a salary or something like that, so it's not capitalized and depreciated subsequently. It's expensed in the year that it's incurred, so that reduces their earnings and their book value as well. And so then if you make these adjustments, you increase their book value and you're reducing their earnings, or you're increasing their earnings as well.
Increase earnings and then reduce return on invested capital.
Yeah,
typically.
that was where I was going. So doesn't it make them look less valuable if you do it that way?
It makes them less attractive on an kind of ROIC or ROE basis, right? Because think about like I think Mobison's done some good work on this, where he looks at like Microsoft and it like has an insane ROE. It's like, all right, this thing has like an insane, but like the capital base that Microsoft has is not true. It's like it's an illusion. If you adjust for the intangible capital, all the R&D Microsoft has done, all right, well now the ROE of Microsoft is like a normal level, right? So you kind of see that effect. And I think it's important to also mention that, for this can actually operate in reverse, right? So what really matters is for the kind of earnings-based approach is the rate at which you're investing in R&D relative to the depreciation or amortization in this case of R&D. So in the case of you're a steady state company, a stable company, and you're no longer investing in R&D, you're kind of just like, just coasting, and you have, a lot of R&D capital from prior years is now depreciating or now amortizing. This actually will be the opposite effect, right? So we're really only talking about companies that are investing in growth and are kind of on this accelerating growth curve, not those that are, maybe R&D intensive, but are kind of on the decline, mature companies.
So can you see then like, you can sweat the assets in a more traditional sense of like underinvesting and like maintenance, and you're just boosting kind of cash flow short term. Do you see the same thing when it comes to IP and or intangibles, where some companies are sort of sweating their intangible assets?
Yeah, but you definitely want to see companies that are continuing to invest for the future. I think that's something you do want to see. One interesting thing I've been looking at more recently is this, which is, I'm obviously a fan of asset light businesses, like, Buffett and most people. But, one interesting thing we've seen with the Mag 7 in particular has been this pivot from this beautiful asset light business model like Google Search to what's effectively like a utility. Right, Meta is spending 1/3 of 30% of their revenues on capital expenditures, which is the same as the average utility. Right, they have a tech multiple, but they're basically trying to build out a utility. And there's many game theoretical reasons why this is happening, and we can go back to prior investment booms, and it kind of makes sense that this is happening. It's not surprising. But one thing I did look at in the context of this, kind of trying to understand the implications of capex, is to what extent does changes in investment rates lead or presage outperformance or underperformance for a stock, right? And so this is a really well-known finding from Fama and French, the so-called investment factor, which is this idea that companies that invest tend to over-extrapolate the prospects of the future and tend to then underperform. So I did something interesting, which I actually bifurcated that into two components. What if companies that invest heavily, but they invest in intangible assets versus tangible assets? And the companies that are investing in intangible assets do just fine. It's really the companies that invest in physical capital expenditures that have historically at least suffered. Again, on average, I'm not saying that this is going to happen to Meta. I'm just saying that on average, this has been the pattern that investment in physical infrastructure has not been rewarded by the stock price. Right. And this is, of course, what we saw in the dot-com boom, right? When you had companies like Global Crossing basically go to zero. We saw it in the railroad boom as well. Now, in this case, it's a little bit different. I don't think Meta has any, balance sheet issues or any shortfall of free cash flow, but, definitely, it's a, concerning development, especially for a component of the market that's now 40% of the index.
Yeah, that was where my question was going. I saw a chart on Twitter last week, at the end of last week, that said that the Mag 7 or whatever the AI CapEx spenders are classified under, they're spending something like 60% of cash flows, which is like double what it was 10 years ago, on on this build out, and then the impact of that will be in about 3 years' time that their return on invested capital is probably half where it is now as a result of those depreciation amortization starting to hit the financial statements. What do you think about the likelihood of that?
Yeah, I mean, look, I think we don't really know what the return on this investment will be, right? Like there is a state of the world where we achieve, artificial general intelligence, and, there's only a few companies that have the servers to do so, and they somehow are, they are a cartel, and they don't cut prices, so they kind of collectively earn all the rents. There's a state of the world that happens. There's also one in which, artificial intelligence disappoints, that it's not adopted by the enterprise. There's no real use cases. It's too kind of faulty. And even if it does succeed in the long run, there's a state of the world where there's a short-term hiccup, in which case these stocks which are kind of priced close to perfection will re-rate, and these companies will have to readjust their investment plans. And then there's the base case. And I think, Toby, what you're outlining is the base case, that, we're transitioning from, think of, like, I don't know, like Meta as being the average of this amazing asset-light business model and this, like, kind of okay utility model, right? That's my base case, which is that, like, they're just kind of averaging into, like, a less good, business, right? If they could spin out this data center thing, it would be less attractive. But, like, there's of course like these, really extreme tails. That's, difficult, of course, to kind of handicap that probability. So it's hard to say. I mean, the way I think about things is just from a risk standpoint, which is like, there's basically been one risk vector, so to speak, that is now kind of driving markets up, markets down, and that is, Mag 7, and more particular AI, the AI, kind of theme within Mag 7, right? If people are bullish, then stocks go up, and if they're bearish, stocks go down. And, like, it's not a great market structure. It's kind of a fragile market where there's one, principal component driving everything. And so to the extent, you are an investor, you're thinking maybe, I've done pretty well holding S&P 500, NASDAQ, QQQ, whatever. Like, that's been great. But, like, at what point do I want to think about taking these chips off and maybe diversifying into other things? And how do I do that in a way that's not just kind of buying companies that are, oppositional to this, that they're not negatively exposed to innovation, they're just, like, at least neutral or still positive, but maybe just less, concentrated in a few names.
I think it's funny to look at the reaction to the market to the spending now versus when Meta was doing it a few years ago under the metaverse, you know, name, which people just hated, and it sold off. And I guess that some of that reinvestment was happening before it wasn't CapEx, it was happening sometime further up the financial statement. So it was like crushing their free cash flow as well. So I guess there were two elements to it, but I feel like there was this fear that everybody had sealed themselves into the rocket ship with Zuck for the run to the metaverse, and then halfway through, 2 years in, he decided he didn't want to do it anymore.
Yeah, you remember that when he did when he kind of called off the investment splurge, called for the year of efficiency, his stock, did really well, right? So I mean, there is that would be the dream state for these companies, I guess, right? That's the other dream scenario, where it's like one in which they all kind of collectively say, you know what, this was a kind of fever dream. Let's just, like, step away, no more investment. Because I think one of the concerns, I think, is that a large component of the reason why these companies are investing so much is this kind of game theoretical arms race component, where it's like, if you're Google, you need to protect search at all costs. That's your entire business. And to the extent there's something that could potentially, impinge on that, you need to, there's not a choice, right? I think Zuck has even talked about this specifically, but, like, how, this FOMO trade, and so you have to, the downsides of not investing are too high, right? So you have this kind of, like, from a prisoner's dilemma standpoint, you're better off all doing one thing, but they do the opposite, because, like, they don't want one guy to be the one who races ahead, like China or, SoftBank, and then they kind of miss out. So, like, they all have to invest, which it makes sense, it's rational for them to do it, but it's, like, not necessarily collectively the best thing if you're a shareholder in all those companies collectively.
No, and they're now, they kind of had their own little fiefdoms carved up where they were all, like, making a lot of money, but now they're all going to compete in the same space. And yeah, maybe not as much profit pool there after when everybody's in this blood red ocean together.
That's right. Yeah.
I think it's funny to see how much internet traffic seems to have fallen off most big websites, which is clearly people not doing that traditional thing where they had go to Google, go to search, click the link, read the page, and now they use basically AI just gives you a summary of what the top something websites say. And so I
It's like
think that,
informational, like, gathering.
yeah. And so a lot of people use ChatGPT or whatever their provider is as their search window. And so there's no need to go through Google anymore. So I imagine that Google has seen that from their side as well.
Yeah,
And when you Google
so
something, are you just reading the top little,
Yeah, or
Gemini
regularly,
prepared section
regularly.
now?
I do
Yeah.
that.
yeah, I mean, it just depends on like what specifically you're trying to accomplish. But yeah, I mean that I think like there's a significant percentage of search traffic that can be just, satisfied at that stage. Like you don't need to even ask further questions or dig any deeper.
It's going to upend the business model for a lot of content providers out there. It's a very different approach. I don't know how they deal with it. I've certainly seen across a very large number of large websites, like the traffic is down significant numbers in the last few years, like 25, 30%, which would be very, very concerning if I was running one of those.
I saw that Substack's apparently doing pretty okay.
Substack was the only one that was kind of like up and still performing really well. Yeah, well, we probably saw the same chart. Yeah, that's right. Substack was the top
How's
left-hand corner of the
how,
chart.
Yeah,
how's
why do you think that
Pornhub though?
is?
That's the real question.
I'm
Doing just
assuming
fine.
I'm assuming they're blocked on ChatGPT.
Yeah,
Yeah.
I guess they've got an email direct to consumer type business model where how often do you go to the Substack.com to read it? Like often it's emailed to you and you just read it as an email.
I mean, again, look, maybe I'm an optimist here, but like, and I'm just kind of like warping things to my worldview. But like my thought would be that, much of the content is commoditized, right?
Yeah.
Like you can go, they've already scraped Wikipedia and like just the random web. And so like what really matters now to kind of get the incremental improvements on models are like the kind of really truly unique content. And so like long tail stuff, like because it's been shown, right, that like it's not about the amount of content, it's about the quality. Like one good, data point, one good piece of content is more valuable to training a model than, 1,000 kind of like, whatever, just noisy kind of, low quality, right? So to the extent that is true, which maybe that'll be proven wrong, folks like I think Reddit, for example, is like a really important source of training data for a lot of these models. And just because it contains, as we discussed, like this kind of long tail of interesting opinions and whatever. So like, you could envision a state of the world where that actually ends up kind of continuing down that path, where like you have even before AI you get all these like content mills, right? They're generally outsourced to like other countries where people just kind of put slop onto the internet and like use it to generate SEO traffic. Like that, I assume is going to be dead because now you can just do that on AI. But at some point, it's like, well, does that's not really incrementally useful to the society or to the AI models more importantly. And so you'd expect that, people who are creating like, genuine content would actually be, advantaged in that world. But I don't know, maybe that's just me being optimistic.
Yeah. How do you have like it's how good can AI be if it's just trained on listicle?
Right, exactly.
BuzzFeed articles.
Yeah.
I will say, like, when I've used AI in my writing, I haven't found it to be that useful, and at least this is as of today, that useful in like actually generating the writing. But one thing it's really good at is generating like headlines, because like I'm pretty bad. So like I will try to post on LinkedIn or Twitter, like, oh yeah, I just put out this new research piece, like, I'll say it in my own voice, and it's pretty boring. It's like an academic, like whatever. And then
It
like I'm
knows you
like, all right,
so well.
ChatGPT, make this better. And it'll like give me like this like really kind of snappy headline, like take out like the key stat. Well, 40% of people are like, and then you put it up there and like I suddenly get so many more clicks. So I don't know. I mean, obviously it is trained on social media data and it does know like what makes a good headline. Which I don't know. So I guess like that just goes back to the general idea, right? Which is that like we should be using AI in areas that we're below average, right? Because if AI always gives you the average outcome, if you're really good at something, don't use AI. If you're really bad at something, then yeah, you should use AI. And I'm really bad at writing headlines, so AI is a great companion for that.
It's got very mid tastes, I find. So when I always try to get it to do some writing for me, and it writes in this really like predictable kind of cliched midline way that is just so incredibly boring to read because it's like just a mishmash of everything you've ever read before, which I find really frustrating. But I think you can train it to give you good titles. I think it is quite good at that.
Yeah, and I think to your point about it giving mid content, I think that has only become more worse over time because a lot of the content we see online, like maybe we don't really truly internalize that this fact is actually AI generated now, right? Like my
Mm.
guess, if you scroll through Twitter or whatever, like you just look through some stuff, that a significant percentage of the content is actually AI generated, and so like it just starts to all blend into the background. And so, part of what you're saying is maybe like 5 years ago, you would have been like, oh, this is like a game changing thing. Like, content's amazing. And now it's just everything, they all use the M dashes and have like the word delve or whatever, right?
Yeah.
You're like, all right, well, this is AI generated.
That's a bummer
Although
because I
annoyingly,
like the M dash.
I
I
actually
do
like M
too.
dashes.
It's
I've been
annoying.
using them for years, maybe years. I'm kind of annoyed that I can't use them
Yeah,
anymore.
yeah.
Yeah.
I, I use them if you write in Google Sheets, which Google whatever it is, which I prefer because then it's available from computer to computer. The M dash is just three of the dashes. It's so easy to put in. It's harder to do in Word, and yeah, now it turns out that's a sign of AI writing, which is a bummer.
Right.
Ruined it
J,
for you.
JT, top of the hour, you want to take a chop at some veggies?
I will. Um, I knew that Kai was coming on the show today, and I knew that he was interested in this topic. I saw him post a tweet about it, and I'd been reading it anyway, so I thought it would. I'd been saving it for when he was coming on. And we're talking about cash holdings, and it starts with this question of why do some companies run their liquidity super tight and others sit on these mountains of cash? And so you might be thinking like, well, isn't having more cash always a good thing? Isn't it safer? And as with most things in business, like the answer is it depends. It's complicated. So cash can kind of be a blessing or a curse in some ways. So too little is obvious. The company risks collapse or is fragile to downturns. But too much, then it can risk dragging down returns on equity, obviously. But it can also frustrate investors when it's sitting there, and probably most importantly, it's tempting for company management to do these creative or destructive, often ego-driven decisions. M&A activity that when you're sitting on a fat wallet, you can make some stupid decisions. So um, there's this tension and between safety kind of on one side and stagnation on the other. And that is at the heart of this recent white paper from Michael Mauboussin and Dan Callahan that was called Cash Holding, Data, Theory, and Alternatives. So we're going to do like a little mini book report today on that. So the Michael looked at, he analyzed over 5 decades of data across industries, life cycles of businesses, global markets, and to understand how companies think about cash and how have they expressed that. And their conclusion is that there's no universal right amount. Instead, cash is kind of a strategic lever to be run inside of a business. So we'll start with some of the scale of it. At the end of 2024, the US public companies, excluding financials, were sitting on about 2.5 trillion of cash. That's no small change. It's about 4.7% of their total market cap and 9% of their total assets. And for reference, the average from 1970 to 2024 was about 7.5%. So we're kind of in normal territory right now. This cash is not evenly spread out across the corporate spectrum. A handful of giants account for a very disproportionate share of it. Just 10 companies, the top 10, hold 1/4 of the excess cash. About a third is held by just 21 companies, and entirely half of that 2.5 trillion lives on only 67 balance sheets. So it's it's a power law.
I thought you were going to say 7 balance sheets then, but that's fine. Keep going.
No. And so in Berkshire, which was technically excluded from the study because it's labeled as a financial, they've got north of probably 350 billion at this point on their balance sheet. So since the 1970s, companies have steadily raised their cash balances from an average of about 6% of assets to in the late 20th century to almost 10% in 2001 to then 11.5 in 2020. Now, not every industry hoards cash in the same way. Healthcare and technology dominate the rankings. In 2024, the median healthcare company had nearly 40% of its assets in cash. For biotech firms, sometimes a lot of times they're pre-revenue, and so they'll hold even higher. Sometimes more than the market cap entirely is held in cash. Technology isn't far behind them, with the median at 23%. So think of software firms, with big R&D pipelines. And then by contrast, on the other side of the world, you have utilities and energy firms, which they rely heavily on tangible assets, and they enjoy relatively steadier cash flows often, especially on the utility side. And they'll hold very little cash then, and often less than 4%. And in fact, even sometimes utilities are forced to take on leverage from the ratepayer's perspective, wanting to have a lower cost of capital. So this split reveals a deeper story as well. Like it's not really just about risk management necessarily. It's also the nature of the business and the asset the cash has been supporting. So there has to be some common sense to that. If your assets are all intangibles like codes and patents or algorithms, all the stuff that Kai's been talking about, that those things don't make for very good collateral. Banks are pretty hesitant to lend against them, and which means that companies that are kind of reliant on tangibles, they kind of end up self-insuring that by holding more cash. And as you know, over the last few decades, the corporate world has shifted from building factories to building a lot more intellectual property. So let's see. The life cycle of the company is the next thing. This also plays a critical role in cash policies. As you'd expect, early stage companies, pre-revenue companies, they tend to hold a lot more cash. Their operations and investments, they eat money, and this financing, finance can provide a lifeline, but at that stage, like you need to hold a lot of cash. And that the median then firms for early stage is 31% of assets in cash. At maturity, a company is ideally cash generative, and then the ratio then falls to about 8%. And then in decline, actually cash balances arise again as sometimes, there's divestitures that a company can do or a shrinking operation that might be in runoff. And so you'll see cash balances balloon again. So there's kind of this U-shaped curve in the life cycle of the business as far as cash balances go. All right, quick quiz question. Was corporate debt to total capital higher in 1974 or 2024?
74.
74.
Well, you guys are correct. Of course, if you knew you would be. So 40% debt to total capital in 1974 and 15% in 2024, which is a little bit surprising. You kind of have this narrative that like, oh, everyone's over levered today. Maybe not true. Now, why do firms hold cash? Economists and finance scholars point to 4 explanations. Number one, precautionary motive. It's kind of the simplest, like cash is an insurance. When markets freeze, companies with cash survive. COVID-19 revealed that in a big way, right? Like airlines, which, had been spending their free cash flow on buybacks, all of a sudden face like literally zero revenue. What do you do then? You need a cash cushion. Number two, tax management. Before the 2017, Trump tax cuts, there were lots of cash that was parked overseas, these U.S. multinationals, and they didn't want to repatriate it and pay the taxes on it. So that led to these massive offshore cash piles. Number three is option value. Alice Schroeder had said that Warren Buffett thinks of cash as a call option on every asset with no expiration, which I thought was a pretty eloquent idea. And in volatile markets, ideally, like a cash-rich company has this anti-fragility to it where they can, strike quickly and buy distressed assets or invest in opportunities that their rivals can't touch because they're flat-footed with not having enough cash. And then the last one is agency theory, and this is probably like the most cynical explanation. So this would be, managers may hoard cash because everyone else is doing it basically in their industry, and they don't want to look like an idiot and be cut out. So they're reducing their own personal risk by doing what everyone else is doing. So maybe that means running it at a red line of cash, where you're really low and levering things up because all your competitors are. And then there's some studies that show that public companies hold twice as much cash as private ones, which suggests that like governance and incentives do play a role in this. So we'll wrap this up here. It's already running a little long. So peer averages aren't a policy. They're really kind of more of an alibi, which speaks to that, what we were just saying with these principal agent problems. The real question isn't how much cash, but really what would you make? What would make you spend that next dollar or give it back? I think that's like an important part. And if the board can't really answer those cleanly, like the market will answer for you. And then lastly, cash is a mirror. It shows, fear or hubris or readiness to act. So if you read the balance sheet and the cash flow statements, and you can often see the strategy that's then revealed, like you can look through 10 years worth of cash flow statements and get a pretty good sense of what management thinks. And or sadly, sometimes the lack of a coherent strategy, which also comes up. But when it's done well, it probably rivals one of the most important levers that you have to pull in the investment equation.
Good stuff, JT. Usually
Nice.
I'd go around the horn and give everybody a shout out, but my text window's not open today. I can't get it to open up, so I'm sorry about that. I don't know if the text is appearing for everybody watching from home or not, so I hope it is, and well, I'll have a look. I'll check it on the recording. Kai, you did a piece on crypto where you're talking about some crypto factors. Are there factors in crypto beyond momentum?
Volume.
Yeah, I did this paper, and I got savaged by the value community. So
By the value
um,
community or the
by
crypto
the value
community?
community,
Well,
by Cliff Asness at the
somehow
Financial Times.
Cliff ripped you
um,
apart. Oh no.
yeah, no, I mean, look, like, and to be fair, I mean, look, like, isn't this what he does? No, but look, like basically the idea of this research was to say, okay, we obviously know there's a market factor in crypto, like there's in every asset class. That beta is, not perfectly correlated to the stocks, and so that's its own factor. There's
How do you
arguably a
measure it?
side.
Is it Bitcoin?
In this case, I did a market cap weighted index
Okay.
of all crypto, which is basically Bitcoin
Okay.
until more recently. And then, there's a small cap factor, so small versus large, kind of the same way you define it in Fama French with stocks. And then momentum, which you mentioned. And then the final thing I did is to kind of create this intangible value factor. So, I mentioned intangible value in stocks and how that's created using kind of patents and how much price versus, per using the patent. In the case of crypto, it's a little bit different where the entire, value of these companies are generally being built in the open. So you don't really have patents, you have open source code. But what you can do is you can go into GitHub repositories and say, hey, how many developers are working on this? How many different commits do you have? How many lines of code? The nice thing is, of course, on the blockchain ledger side is kind of by definition for each chain, you can kind of see, in real time, basically, how much activity, how much dollar transaction volume is flowing through the ecosystem, right? So think of it as like basically opening Visa's 10Q every second. And you can also look at daily active users, so kind of a SaaS style metric. How many unique wallets are operating, how actively are they transacting, defining activity in different ways, right? So you can actually create, at least in my mind, kind of fundamental metrics the same way I mentioned across these four pillars, human capital, brand, IP, network effects in crypto. Now that just the data sources are a little bit different and in some ways actually better. And so basically I built this and, without going too much into details, that was kind of the fourth, I guess, fifth factor or whatever, right? So then I said, all right, like let's try to, go around and kind of test each of these things. And so, market worked. Small cap has historically worked, although not more recently. And again, it's maybe the same thing that's happened in stocks, where Mag 7 is dominating stocks and maybe Bitcoin is dominating until more recently crypto. Momentum is interesting because, it does seem to work historically. The one thing is that it operates on a faster cycle. So whereas like in equities, you typically look at like 1 month, 12-month momentum. So 12 minus 1. In crypto, it's more on a matter of weeks.
12
Which makes
seconds.
sense because not maybe it works in seconds too. Maybe there's actually being inversion on a second horizon. I bet you there is because of the microstructure. But at least on the weekly horizon, say 1 month to 1 week or 6 weeks or whatever, to 1 week, you're seeing some strong trending behavior. You also find something interesting when you intersect. I guess the fourth one is intangible value. You do find a value factor or this intangible value factor in the data. So one interesting thing shows up when you like intersect these factors with size, right? So think of like Morningstar style boxes, right? Small cap value, large cap value, small cap momentum, large cap momentum. In crypto, at least, momentum tends to work better in large caps, right? And that's a little bit counterintuitive because in stocks it works better in small caps, or it has historically. And I think that has to do with a few things, right? There's the argument that the largest assets are more macro assets these days, like they're Bitcoin's like digital gold, right? It's a way of getting exposure to fiat or whatever, right? And so therefore that's where kind of you see a lot of the trends. There's also like a lot more narrative attention is being spent on the large caps, whereas the small caps are kind of forgotten. And then the final piece just being leverage, that you can lever up, Bitcoin and ETH and these sorts of assets, and so you end up with these kind of cascading effects where you have like these virtuous and vicious cycles due to leveraging and deleveraging. When you don't really have that in small caps, if you can't really lever up your like Flower coin or whatever.
Thank God.
And then, I found that intangible value tends to continue to work pretty well, works better in small caps than large caps, which is consistent with the way that we've seen things work in equities. Now, there's one kind of interesting wrinkle here, which I brought up in the paper, which is, one of the things that people talk about, and going back to Cliff Asness, is this idea that small caps have generally not worked because of this junk component. That a lot of small caps are unprofitable and kind of junky. And so, if you kind of filter that out, it tends to work again. Right. So I kind of did the same thing where I said, look, these intangible, if you look at intangible value, one thing that's interesting is that by definition, you're looking at price to X, where X is some kind of fundamental metric. And so by definition, anything with a divided by 0 goes away. Right. So you're kind of removing the junk. It's almost like a quality filter, I guess, in the small cap universe. And so that kind of explains a little bit, in my mind at least, why there is less of a small cap effect today, right? Just that a lot of these tokens are basically vaporware. There's no actual users on these things. They get launched in 2021 in the boom, and then no one uses them anymore, and they kind of just sit there as a zombie. In the same way that if you're a Japanese company and you never got delisted after 1990, right? You're kind of just sitting there as a zombie, which is fine. But the problem is that you can never delist these things. They're always going to be on the blockchain by definition. You just once they're created, they're there. And so you need ways to kind of filter out some of the speculative tokens, the vaporware, and in doing so, you actually can restore, a lot of the, kind of perceived missing premium.
Has anybody else ever done factor work on crypto?
I saw that Kraken and CF Benchmark came up with a piece recently. I'm not exactly sure what it said, but I did see that they put something out on that topic. There have been a couple academic papers that have looked at these sorts of things. I don't think they're widely circulated, but I think I cite them in my paper. So they're out there. And yeah, I mean, I think it's, my guess is that what we're seeing in crypto is kind of what we saw in equities, right? Where it's you start out with just Bitcoin, where it's and then over time you build out these index funds like Bitwise has, Bitwise 10, these sorts of products, and then you start to see, kind of smaller cap things get launched, and then eventually you have asset pricing models that kind of come up in order to help investors understand what's going on in the long tail of assets. And that's when kind of the style premium, right? Basically AQR's built their business, pick on Cliff, on this whole idea within equities, right? And I think it may not be me, but I think somebody will eventually over time kind of build the same edifice out in the crypto space. Why wouldn't they?
And what was Cliff's critique of the paper or of the
I don't think he likes crypto.
Okay.
Just stop there.
Yeah.
Because somebody gets the Nobel Prize in economics for this, so it's you or one of these other guys who published their paper first. You're the femme French of crypto.
Yeah, there you go.
I hope not.
So back to the equity side. Yeah. The phenomenon that I have observed, and I've been tweeting out a bit recently, is just this dominance of large cap over small cap. And it turns up any way you want to cut it. If you look at the S&P 100, which is the largest 100 versus the 500, and in this instance, the 500 is the small, you still see this same effect where you get the 100 massively outperforming the 500. You see it in equal weight versus market capitalization weight. You get almost exactly the same shape. So does any of the work that you do, does it put that into any context? Does it explain that market capitalization? Does it sort of normalize for it, or how do you deal with that?
Toby wants to know when it's going to stop. Also,
that's exactly what I'm asking. That's exactly what I'm asking.
So look, I mean, yes, small caps have underperformed large caps, but if you were the counter argument, right, to what you said is that, well, actually, large caps have had earnings growth that has justified their appreciation, right? The Mag 7 have actually, had earnings growth. We'll see whether it persists. That has been pretty impressive and has kind of justified the increase in their price. Whereas small caps, international stocks, emerging market stocks, these kind of unfavored categories have not, right? I focused more on international stocks. I did a whole paper on this where I found that, over the past, 10, 15 years, in kind of real US dollar terms, so adjusted for inflation, international stocks have basically had no earnings growth, which is pretty disappointing. And, to some extent, that's, I think, at least the reason why they've underperformed. So not only have their earnings been tepid, but investors are extrapolating that out moving forward, and hence they have experienced no say margin valuation expansion, whereas in the U.S. they have, because the index has become quote unquote higher quality, more growthy, and as a result, investors are extrapolating that moving forward, right? And that same story, I believe, can be applied to small caps, right? Which is small caps companies have underinvested in intangible assets. Think of the example of like JP Morgan and a lot of these big companies that are hiring all these AI engineers and launching blockchain initiatives. And you have like the regional banks, which I don't know what they're doing, right? They're not doing well. So like, I think you see this kind of across the economy, both in terms of value versus growth, US versus non-US, large cap versus small cap, where the folks who have invested in tangible assets over the past 2 decades have actually experienced higher growth. And like you can show this. Like I mentioned that like study I did on the cross section where I said, there's a J curve, right, where companies that invest in intangibles have then subsequently gone on to outperform those that have not. And that can be applied on the aggregate level to different groups, whether it's like US versus Japan or US versus Europe or US large versus US small or value group versus growth. So a lot of the kind of like perceived discrepancies that we're seeing in growth rates across groups, I think can be explained, at least partially, if not fully, in many cases, by this intangible discrepancy. Now, multiples have also changed, right? And perhaps they're overshooting in some cases, and I think in most cases they are overshooting. And so, in other words, said differently, right? And I actually debated Cliff Aston on this too, is like the value growth spread, right? Like it seems like it's at all-time wides, and will that lead to future stock returns that are extraordinary for the value versus growth? Like I think there's kind of two components. One is that if you adjust for intangibles, the gap's less big, but there's still a gap, right? So it maybe explains half the gap in this example. So I think that it does help explain what's going on, and primarily through the earnings channel, but that the multiples are still a little bit kind of over extrapolating. I think in this case.
Is it a compositional problem? Because accounting doesn't deal with software particularly well, because software is unlike a physical edifice. It's something that this expense runs through the salaries of the engineers who put it together, and there's not a lot of like material that goes into it, and so that's where all of the problem is. To what extent do you see intangibles sort of predicting returns outside of tech?
Yeah, it's interesting. So you can run these intangible value like studies both within, across the market where you're allowed to go bottoms up and choose the sectors, or you can constrain it to say, all right, I'm just going to kind of pick the most intangible value stocks within each sector, right, or within each industry or within each country. And in general, you find that intangible value works in both the new economy and the old economy. So it works in software, obviously, as you might expect, but it also tends to work in even sectors that are kind of more traditionally asset-heavy businesses. And I think the reason why is just that there aren't any growth investors who are even trying to price these things in those sectors, right? Growth investors are all kind of all over tech, and they just have basically left the old economy for dead. And as a result, like if no one's looking at it, even having a small edge, even if the edge is only on a smaller share of the balance sheet, that's still meaningful. Now, what's really interesting, actually, I looked at this, and I think this is actually worth mentioning, is the counter of this, is the opposite of this, which is traditional value. Take the most basic Fama French price to book vector. If you are careful in how you constrain the universe to only be kind of old economy or low, to be more precise, like low intangible intensivity companies, actually it's done just fine, right? So traditional value has done just fine if you exclude the sectors of the economy that are the regions, the stocks that are more intangible intensive. Of course, the problem there, and then the counter argument to that, the problem with that is that share is becoming diminishingly small in the U.S., right? Like that used to be most of the market, and over time it's becoming smaller and smaller because intangible assets matter for every company now. Maybe less for some than others, but is still important. But I think it does at least make a kind of point on principle, whether or not it's useful in practice. That maybe it is the case that that some of these factors have been underperforming because the omission of these intangible components, which when added, you should in theory correct it.
It's interesting because one of the observations that Cliff made was that price to book did work pretty well through that period of time when value was really getting hammered specifically, because price to book was the less good value factor, and so the ones that were
the worst value factor,
yeah,
the one least
did better.
representing
The
value,
weakest
so
value
it
factor
did
did
better.
the best. Yeah.
Yeah, I think that speaks to the cyclicality part, right? Like these types of like value factors, like there's two reasons they outperform. One is just like there's a recycling effect, right? That via these stocks, prices rise more than their earnings underperform, and that growth stocks underperform because they, grow less than the market's pricing in, right? That effect seems to have diminished, at least based on what I look at, and over time. Whereas like the cyclicality component, where like there are groups of stocks, tech versus energy, U.S. versus emerging, value stocks defined this way versus book versus growth stocks that do go through cycles, right? And I think it is undeniable that value stocks are in a disfavored sector right now. And at some point, that rubber band will likely snap back, and these stocks will likely experience a cyclical rebound. Now, will the trend line continue to be, if you go back to the Fama French chart since 26, there's just been this nice like 5 percentage point of like, smooth outperformance for value versus growth. And then obviously the past 15 years has been kind of falling off that. It may rebound, but will that necessarily mean that the trend line will continue to be up? That I think is more open to debate.
Do you have any view on, I saw you wrote one of your pieces on trade wars. Do you have any view on the tariffs?
Yeah, so I wrote that paper maybe a week after Liberation Day or 2 weeks after Liberation Day. And kind of my point there is, a lot of people were starting to kind of get concerned about geopolitical risk, and to the extent that most people have home bias and they're mainly invested in U.S. stocks, we're effectively dumping their multinationals to buy domestic stocks, right? Like RH is the best example of a stock that went down like at least 50% or something like a single day to go buy utilities and safe stocks. And so what we wanted to do was ask the data and say over the long, arc of history, it was that would actually have been a good strategy. And what I found is that multinational stocks, whether importers, exporters, or pure multinationals that both import and export, that class of companies has massively outperformed their domestic peers, whether in the U.S. and Europe, whether adjusted for sector, just kind of on all dimensions that these companies have done better. And one explanation, right, is selection bias. That if you're an A player, you want to compete on the global arena where the TAM's bigger. If you are kind of a B player, you want to kind of hide in your local market and use tariffs and kind of export controls or whatever import controls to kind of protect your niche. Right, so that could be one explanation, but it could also be the fact that being able to be connected in a free trade ecosystem is actually helpful, right? The idea of outsourcing to lower your costs, to access customer bases across the globe. There's a lot of tax advantages that multinationals can access that those who are stuck in one country don't necessarily have the ability to do. So anyways, I thought that was a really interesting finding. The other kind of finding I homed in on related to intangible assets is this idea that intangible assets. So first of all, multinational companies tend to be more intangible. There's like a positive correlation. Not all of them, but like sometimes. Like it's a imperfect but positive correlation. But the other thing is that like when you think about tariffs, like what are tariffs really doing? They're making it really hard for a good that's being exported through over a border to pass without like a tax. Intangible assets, by definition, don't have to pass borders, right? You can't tariff an intangible asset. And so it kind of became a really interesting way of building a portfolio that is still long globalization and still long free trade, which to me is capitalism's golden goose, right? I like free trade. But to do so in a way that is more insulated to some of the risks that we've seen with governments being able to kind of like capriciously put tariffs on their trading partners. And obviously, like think of a company. There's obviously shades of gray, whereas like you have pure intangible revenues, like software licenses, and then you have pure physical goods, and then you have the in between, which are like Apple's iPhone, which is like of course a physical asset, but a lot of the value there is kind of the IP. And so there's some kind of transfer pricing it gets really complex. But there's of course an in between category as well. But like staying kind of the most intangible intensive companies tend to actually be relatively well positioned for trade wars.
Yeah, it's fascinating stuff. We're coming up on time, Kai. So if folks want to follow along with what you're doing or get in touch with you, what's the best way of going about doing that?
Oh, you can go to my website. It's just sparklinecapital.com, and you can read my research there. And I have a form you can kind of submit any kind of like messages to me, or you can email me directly. You can find my email actually on any of my white papers, which are on my website. It'll be in the upper left-hand corner.
And you're on Twitter too.
I am. My handle
Wu.
is my handle on Twitter and LinkedIn is the same. It's C Kai Wu, CKAIWU.
Good stuff. JT, any final words?
No, thanks for coming on, Kai. It's good seeing you.
Yeah, no, fun. I'm glad I could join Value After Hours.
Thanks, Kai. We'll be back, folks, next week with any luck with the chat fixed up again. So I hope that's working then.